During the risk assessment stage of the audit, one of the key concepts that we're going to investigate is the idea of materiality. We want to know for the company in question what constitutes a material misstatement. So during this stage of the audit, we're trying to put some numbers there to use as a benchmark basically to kind of figure out what would throw off the end user of the financial statement. Remember, if a misstatement is material in nature, that means that the misstatement is going to affect the end user's interpretation of those financial statements. And this can differ from company to company. You could have two companies with an identical misstatement in dollar amounts, but it could drastically differ in how it changes the end user's interpretation. Imagine you have a company that has maybe $5 million in total revenue. If they misstate their revenue by $2 million, that's a huge deal for that company. But if you have a firm like Apple, if they misstate their revenue by $2 million, that's a drop in the bucket when they're earning billions and billions of dollars overall. So it's really dependent on the company in question. There's a couple different ways that auditors describe materiality. First off, there's quantitative factors, and quantitative factors just refer to the magnitude, the size of a potential misstatement. So for a company like Walmart or Target, they have huge levels of inventory. If there's a certain dollar amount of inventory misstated, that could throw off the judgment of the end users of the financial statements. Maybe those end users are investors, potential suppliers to the company, whatever it may be. So the idea of a quantitative material misstatement is just the number, the raw dollar amount is so large, it could throw off the end users. Now, compare that to a qualitative factor. An example of a qualitative factor is maybe in the notes to the financial statements, some important information is missing. So maybe a company had a change in accounting policy that they're supposed to note in the notes to the financial statement, and they don't have it noted there. It might not be a huge dollar amount. The change might not be significant in magnitude, but the lack of that information could throw off the end user's interpretation of the financials. So it's not the raw dollar amount in the case of a qualitative misstatement. It's really the nature of the information that isn't being stated correctly that's going to have an effect on the audit. Now, auditors have some benchmarks they use when they're trying to determine materiality for a company. In practice, you see total revenues used a lot, total assets, total equity, net income before taxes is a big benchmark. So what's going to happen is the auditors are going to look at these benchmarks and use a percentage of the benchmark as their threshold for material misstatement. So maybe a company had, let's say, $100 million in total revenue. So they got a total revenue of 100 million. And let's say that we determine that we could have a material misstatement if it's over 2% of total revenue, right? So what you would do is just take the 100 million times 2%. All right, so any misstatement over 2 million would be considered material. It would throw off the judgment of the end users. Typically, total revenue, total assets, total equity, you'll use a lower percentage when you're doing this calculation, as opposed to if you had used net income before taxes as your benchmark. The reason is typically companies are going to have more assets, more equity, definitely more revenue than they have net income. All right, so net income in total is a smaller dollar amount compared to these other categories. So you're going to use a higher percentage when you try to do this multiplication to determine what the materiality level is actually in reality. Now, when we conduct the audit, of course, it's not foolproof. So when we set up that level of materiality, it's not taking into account the fact that we might not catch some of the errors. So in that last example where we had the 2%, that's the materiality threshold. We might have a level of performance materiality, all right, that is less than that materiality threshold that we put before. So let's say, in the last example, we said $2 million, a misstatement of $2 million would be considered material based on, the calculations we made. Well, a performance materiality is actually a number less than that. Maybe we'd set performance materiality at $1 million to account for the fact that, we can't catch every misstatement. So even though we think the end users would only be thrown off by a misstatement of $2 million, we're really going to be on the outlook for misstatements of just $1 million, because we want to give ourselves some leeway, some wiggle room, because we know we can't catch every potential misstatement. We're not going to catch every error in accounting transactions that's made by the company.